In this video, we're going to use the cost recovery model in Part A in order to check to see if there's impairment and proceed with the journal entry if there is. So we'll read through this question. The information that follows relates to equipment owned by Gaurav Limited at December 31st, 2020. So we have the cost, accumulated depreciation to date, expected future net cash flows undiscounted, expected future net cash flows discounted, fair value, and cost to sell. Assume that Gaurav will continue to use this asset in the future. As at December 31st, the equipment has a remaining useful life of 4 years, and they use the straight line method of depreciation. So assuming that we're a private company and we follow ASPE, we would use the cost recovery model. So it says, prepare the journal entry at December 31st to record asset impairment, if any. So in order to use the cost recovery model, I first need to check for impairment. So what I'll need to do is see if my cash or my carrying value is greater than my undiscounted future net cash flows. And if they are, then there's impairment, and then we would have to write the asset down. So the undiscounted future net cash flows is just this value right here. So under the cost recovery model, we use the undiscounted cash flows. So that's 7 million. And the carrying value is just the amount on the book. So that would be the cost minus the accumulated depreciation. So that's 10 million minus 2 million. So cost is 10 million. And accumulated depreciation was the 2 million. So then we have a difference of 8 million. That's the carrying value. So in this case, the carrying value is greater than the undiscounted future net cash flows. So that just proves to me that impairment does exist. So what we need to do is actually now write the asset down to its fair value. So the carrying value is the 8 million. So we only do this if it's impaired. So the first part was the test, and now this part is us recording the impairment on the books. So the carrying value is 8 million, and the fair value is 6.2 million. So then the difference is your adjusting journal entry. So I'll just say adjusting journal entry. So that would be $8 million minus 6.2 million. So the adjustment is 1.8 million. So the journal entry would look like this. On December 31st, 2020, you would debit loss on impairment for $1.8 million. and then you would credit another contra asset account, and we'll call this accumulated impairment losses, and just on the equipment. And that's for 1.8 million. Now, the next part is to then prepare the journal entry to record depreciation expense for 2021. So I'll just do December 31st, 2021. I'm going to record depreciation expense and then credit my accumulated depreciation equipment. So what we're going to do is we have to revise our depreciation for the new amount that's on our books. So when we actually did the impairment test and we wrote the carrying value down to 6.2 million, we would revise our depreciation rate. So it would be 6.2 million minus the residual value. So in this case, I don't think there was any. And then divide that by the number of remaining years. So in this case, it should tell us how many years. So they had 4 years remaining at the end of 2020, and we're using straight line. So when we do a revision, it's not a change in accounting policy, it's just a change in estimate, and we deal with those prospectively. So let's see here, 6.2 million divided by 4 gives me 1550000 that I'll record in depreciation. And now the last step is the equipment's fair value at December 31st is 6.5 million. Prepare the journal entry, if any, to record the increase in fair value. So we actually don't do any journal entry because under the cost recovery model, we only write the asset down once we decide that it's impaired. And we never end up writing it back up, even if its fair value changes.